Good morning, Craig Harm with the Retirement Advantage. I hope everybody's doing fantastic. It's top of the hour. We're going to begin in about 20 more seconds. We have a number of people not only dialing in, but also getting in online since this is a CE. So bear with us here, and I'll introduce both Ricky and Andy in a minute and the topic, and we'll go over some of our normal logistics of the call. But we want to give everybody a chance to get online here. So we're just about 10 or 15 more seconds from starting. So thank you, everybody, for popping in early. We appreciate that. We've got another large group coming in, and it's just great to have everybody back. You know, we took the summer off as we do, and now we're rearing and getting ready for Q4. So again, I think we're ready to begin. It's Craig Harm with the Retirement Advantage. In the background, you're going to hear one of our senior marketing analysts, Travis Avery, pop in from time to time. And don't forget, up in the middle, there's a question bar icon. Click on that. Send your questions in. Andy and Ricky want to get to as many as we can. And if we can't get to them, we always make sure one of our consultants follows up with you. So please keep those populated, and we'll go from there. Logistics, you're on mute mode as always with us from that standpoint. That's just from keeping background noise. But it is CE. You must stay on the entire 1 hour on screen. Answer the polling questions, and we'll make sure we get those CE certificates out to you from that standpoint. But keep the questions coming. And this is great. We've had Ricky on before. I believe, Ricky, you talked about the Secure Act 2.0. And now we have a tag team with Andy and Ricky about cash balance plans. Of course, we have Andy back, Director of Education, and also founding partner with the Retirement Learning Center with our great friend John Carl and Jenny Kiffmeyer. And Ricky's a part of the parent company, October 3, and is the head actuary. And many of you remember Ricky's background before with Hewitt, Mercer, and Newport. So it's great to have you, Ricky. So thank you. Cash balance plans, an alternative for small businesses. Timing is everything. We're getting ready to hit Q4 in just a few weeks, really a week or two. Where do cash balances fit into that small business owner? How do we set it up? What's the advantages? Can I combine it with a normal, quote, 401k plan? And what are the other logistics around that? So with that said, I'm going to turn it over to Andy Larson. Andy, thank you. It's good to be back together again. And Ricky, welcome back again. I think this is going to be fantastic because between these two, I'm just going to say we've got 70 years of experience in the retirement industry. So we're not trying to do stump the speaker, but, it's great. If there isn't anything they can answer, we'll have to investigate that at a later time. But again, Ricky and Andy, thank you. And Andy, with that, I'll turn it over to you.
Well, thank you very much, and appreciate the chance to talk with you about a topic that I think it's pretty timely. And again, I'm pleased that my colleague Ricky is here. He's the actuary, and during the Q&A session, the tough questions go to him. So I'm very much pleased that I can toss those over. So let's get started. Next slide, please. Here's the housekeeping notes. I'm not going to read them to you, so if you have questions on those, just ask Ricky. Next slide, please. Our objectives. First of all, and probably the most important, is we're going to talk about an awareness of when a cash balance plan may be appropriate. Because I talk to plan sponsors, I talk to advisors, I talk to consultants frequently, and the hardest part about cash balance is the awareness. Where do they fit and where don't they fit? And so we're going to spend a fair amount of time on that topic. Next, we'll talk about 401k and cash balance coordination. Now, you don't have to have a 401k and a cash balance, but in a lot of cases it makes sense. Next, we'll talk about the roles and duties of the cash balance plan, who does what, and I think you're going to be surprised with regard to that. Next, we'll talk about cash balance operations, their function, and then the investment side with the investment process and structure. So let's go to the next slide, please. Where cash balance plans fit, small business goals and questions. And before we go to the next slide, I just want to share what I've seen in the industry, and that is when a business owner is approached with a cash balance question or questioned whether cash balance is appropriate, the questioning of that business owner is usually awful. It's usually way too much detail. It often confuses the business owner, and in a lot of cases they're CPAs. So what we're going to be talking about is hopefully a simpler way to identify where potentially cash balance plans might make sense. And again, this initial approach, as you'll see in the next few minutes, very, very simple. So let's go to the next slide, please. Okay, why consider? Why consider a cash balance plan? Well, a cash balance plan is a qualified plan, and that plan provides the business owner with some significant benefits above and beyond what's available with the 401k. Bottom line, cash balance plans can provide larger contributions and larger deductions than are available with a 401k. Now, I'm not saying this is an either or, because as I mentioned, in a lot of cases, the optimal arrangement is to maintain the 401k and add a cash balance on top of it. Next slide, please. As I have mentioned, typical cash balance plans are done in conjunction with the K plan. You've got larger deferral and contribution opportunities beyond the DC limits, additional deductions, which then potentially protects assets from creditors, and then lump sum payouts are available for either rollover or, in some cases, even Roth conversions. And interestingly enough, we're starting to see, some interest in that too, where an individual is taking their dollars out of a cash balance plan and electing to convert all or part of that into a Roth. So again, some potential advantages of the cash balance arrangement. Next slide, please. So in understanding where cash balance plans fit in, really the first things we need to understand is what plans, if any, are currently in place. Maybe there's a SEP, maybe there's a simple, maybe there's a 401k. Next, what are the contribution levels? What does the employer ideally like to put in and deduct? And then lastly, what's the demographic? What are the employee makeup? Are they older, younger, higher compensated, mid, low range compensation? All these are factors in understanding where a cash balance plan fit. Now, the good news is that advisors, consultants, business owners are not the ones that do the illustrations to really figure out, is there a fit? Again, that's something that people like Ricky, the actuaries, do once they get the employee census. Next slide, please. Aligning the plan with business goals. And I mentioned a few minutes ago, oftentimes cash balance plans are way too complicated initially for business owners, and we just lose their attention. They get confused, they lose interest. What we're now going to do is go through an illustration of how to align the plan, ostensibly the cash balance plans, with the goals of the business. And once this is done, if there's an initial alignment, in a pretty big percent of cases, we find the cash balance plan is feasible, and in fact, actually, it goes on to being established. So let's talk about this alignment process. Next slide, please. Now, as you're aware, there's multiple types of qualified plans. You've got SEP, you've got Simple, you've got 401k with deferral only, you've got 401k with profit sharing, you've got defined benefit, etc. So the question is, which plan is right? And then what questions do we ask to ascertain which plan fits where? Which plan fits where? Now let's distill that down and focus on business goals. Next slide, please. For those of you that love fine print, you can read this chart, and based on this chart, if you're really, really smart and you're dealing with very, very smart business owners, you can figure out exactly which plan fits where. On the left, the rows talks about the who. Across the top, it talks about the types of plans. Frankly, I mean, I'm being a little silly here. This is complex. This is complex, but I use this because this is the kind of document I have seen put in front of plan sponsors to help the plan sponsor try and decide what plan they want. And folks, initially, this is just gobbledygook to a plan sponsor. This is generally not helpful. So this is kind of what not to do initially. Next slide, please. So many factors are important, but where do we start? We start with a very simple question. We start asking the business owner, ideally, how much would you like to put into this plan for yourself and deduct? What is, and we're going to call this the number. Now, when you ask a business owner the number, likely you are going to get a whole bunch of gobbledygook based on what the business owner thinks they understand. And the conversation will kind of go like this. Gee, business owner, ideally, how much would you like to put in and deduct? Oh, well, I'm already deferring my deferral limits and I'm maxing out on the 401k and I'm over 50 and I know I can do this. And what they try and do is they regurgitate back to us what they think they know. But for this to be effective, we have to shut them down on that and say, no, 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 we're not talking about what you're putting in today. In a perfect world, ideally, how much would you like to contribute for yourself and or your key people annually for however many years in the future? Ideally, how much extra would you like to put in, ignoring what you're doing now, ignoring what you think the rules are? You sort of get them off the what I think they know and just get them to focus on the number. The number. Now we're going to work with this concept of the number and go through a couple case studies. Next slide, please. Asking the business owner about their desired contribution is step one. In our example, we have Linda, the advisor, and L, the business owner. And Linda says to L, tell me, ideally, how much would you like to contribute towards retirement each year? And L's answer is going to give Linda a pretty good indication for where the conversation should be directed. Keep in mind, we're not talking plan types, we're not talking features, we're not talking safe harbor. We're just talking about the number. Next slide. Well, let's say that L's number is 5 grand. Well, that simplifies things. If they're looking at about 5 grand, that tells Linda that all she needs is probably some type of IRA arrangement. Next slide. But let's say L's number is maybe around 15,000. Okay, that changes the calculus. That tells Linda we should be talking about maybe a simple IRA or even a SEP. Now, obviously, more questions are necessary, but for right now, at a strategic level, it puts us in the simpler SEP direction. Next slide, please. Now, L responds, maybe 40 grand would be right. All right, what does this tell Linda? Well, it tells her maybe a SEP, possibly a 401k. Again, the answer, the number changes the calculus. Next slide. Now L says, well, I'd like to do 60 to 70. All right, now that's putting us in 401k territory very clearly. Again, the other features would require more questions, but at least we know if 60 to 70 is the number, we're talking 401k. So with that, let's continue to the next slide. All right, now this is, I think, now getting to be a more realistic answer. This would be the kind of answer you get more frequently. And in this answer, L mentions, well, I've delayed setting money aside for my retirement, and I've got to get started. I guess I'd like to set aside a couple hundred grand a year so I can catch up. Okay, 200 grand a year, the number. This response tells us that L should consider the combination of a 401k and a cash balance plan. Because once we get a number that's above those 401k limits, 70,000 plus, once we get a number above that, that puts us in cash balance territory. Next slide, please. Now we have a similar answer where L says, well, I'm maximizing my 401k and I'd still like to set aside an additional 100 to 200 to help me catch up. Okay, this response tells Linda that clearly a cash balance should be explored in conjunction with the 401k. Next slide. Now, before we jump into this, just to review, when talking to that business owner, when a plan sponsor is considering a plan, the key first step is coming up with the number. How much ideally would they like to contribute? Just keeping it simple, sort of directing the conversation in the appropriate direction. On this slide, it gives us really the overview of our opportunity with cash balance and 401k. And Ricky, could you cover this for us?
Sure, Andy. Yeah, so let's take a look here at some kind of theoretical numbers. Um, you know, a person over 50, 55, let's say you got a 60-year-old that's maximizing 401k deferrals, right? Well, look at that additional amount there in that second column from the right. The maximum cash balance amount number. It's almost $300,000 of additional deferral opportunity that the cash balance plan would allow for. That's a very, very significant number there for business owners, especially those looking to catch up, who maybe didn't start, saving for retirement quite as early. That's a very compelling case there when you start looking at the size of those maximum cash balance deductions based on age. Andy?
Yes. Again, look at the bottom right corner, 400 grand potential. A lot of plan sponsors, a lot of organizations, a lot of individuals are going to pay attention when they see that. Next slide, please. Okay, now we've talked a little bit about the opportunity and where potentially cash balance fit. Now we're going to get into the mechanics. And before we get to the next slide, if you're taking notes, I want you to jot down a phrase. Cash balance are not 401k plans. Cash balance are not 401k plans. And I say that because so many of us spend so much time with 401ks, sometimes it's hard to get out of 401k think. So let's take a look. Next slide, please. So here's what's unique about cash balance plans. These are defined benefit plans. That means they're specified annual contributions. Well, who specifies? How do we determine? The actuaries, people like Ricky, determine the annual contributions. Older participants generally receive larger amounts. Well, why is that? Well, real simple. This is a defined benefit plan. If someone is 55 and they want to retire, the plan allows them to retire at 65. The 55-year-old only has 10 years to accumulate the contributions necessary to pay the promised benefit. Let's compare that to a 45-year-old. A 45-year-old has 20 years to accumulate enough to receive the promised benefit. So it's like a mortgage on your house. A 10-year mortgage is going to be more expensive than a 20-year mortgage. The longer time period we have to fund, the smaller the contributions can be. Next, cash balance plans, because they're defined benefit, are employer funded. There is no employee contributions. No employee contributions. And lastly, plan assets are invested in a single pool. There is no 401k type self-direction. All the dollars are invested in a pool, and the advisor or a consultant or a professional financial manager manages the overall pool of investments. Next slide, please. What does cash balance mean? Well, cash balance simply refers to the plan's benefit formula. And recall, this is a defined benefit plan. So what we're going to do real briefly is take a look at some traditional benefit formulas, and then we're going to compare that to the cash balance formula. And a lot of what you'll see is a lot about naming. So we'll go to the next slide. Traditional formulas, for example, include final average pay. Joe is a participant at ABC Inc. DB plan. When Joe retires, his pension will be 45% of the average of his last 5 years of earnings. Okay, so they're projecting that benefit as a pension. When Joe retires, his pension will be each year equal to about 45% of his average earnings. Each year he'll get a check, or each month he'll get a check that results in about 45% of his average earnings. Next slide. Now we have Chloe as a participant in a DB plan, but hers is a service-based formula. Chloe's benefit is 2% of compensation times her years of service. Thus, if Chloe retires with 30 years of service, her benefit will be 60% of compensation. That means every year, Chloe will get a monthly check on an annual basis equal to 60% of compensation, for as long as she lives. Next slide, please. Now we're going to take a test. Which statement regarding cash balance plans formula is true? No benefit formula is required. A cash balance formula is similar to the defined contribution, hint, hint, approach. Cash balance plans use final average pay, or cash balance plans must use a service-based formula. Okay, well, we've got most folks responding. Let's go to the next slide and see how we did. Yeah, the cash balance formula is real similar to the defined contribution approach. Let's drill into this in more detail and see how it works. Okay, the cash balance formula resembles a DC plan. And we'll go through an example. We have Acme Law Firm has a cash balance plan. The benefit formula provides an imputed employer contribution of 5% of pay each year and an imputed interest credit equal to the rate of return on the plan. Oh, wait a minute, that kind of looks like a defined contribution plan. The benefit formula is, but this is still a DB. Next slide, please. Now we've got Elizabeth. She's an attorney at Acme and earns $150,000. Her first year's benefit is $7,500, and there's no interest credit provided the first year. So she gets a credited benefit of $7,500. Next slide, please. Now let's take a look at the next 3 years. Year 1, Elizabeth gets her $7,500. No earnings on that. Ending balance $7,500. That ending balance then rolls up to the beginning balance of year 2. We have an additional $7,500 employer contribution credit. That year, the plan's investments earned 4%. So she gets an interest credit for a balance of $15,300. In year 3, we roll that over to her beginning balance, another employer contribution, another earnings credit. So at the end of year 3, her imputed benefit is $23,336. In other words, if she were to quit that and take her money out, she would get a lump sum of $23,336. Traditional defined benefit plans formulas show the annuity benefit. This shows the imputed lump sum. Now, could Elizabeth take her $23,336 and have the plan annuitize that? Yes. It's not common, but cash balance, the benefit is shown typically in terms of lump sum. Next slide, please. Ricky, maybe I'll have you cover this one. This is more your neck of the woods.
Sure. So some other benefit formula approaches that cash balance plans can use is that the contribution can be age-based. There's some rules surrounding that that I won't get into here, that the actuary who you work with or whoever's working on the design of the plan will know, and will make sure that the plan is compliant. However, the formulas, the contribution can be age-based, so you can kind of increase it a little bit with age. You can increase it with service. You've got some options if you do want to give longer service or older employees a little bit more than you do younger people. Now there's discrimination testing requirement considerations there, but again, that's something that the actuary would worry about and would be handled and made sure it's taken care of in the design phase.
Okay, good point. Next slide, please. Now, as Ricky mentioned, there's different benefit approaches available. For example, we talked about the specified employer contribution. There's also different ways that the interest rate can be credited. Traditionally, cash balance plans used what's called a fixed crediting rate. For example, 2, 3, 4, that was credited regardless of what happened with the underlying investments. Secure 2.0 affirmed a more liberal approach called market value, which means your interest crediting could be what the plan actually earned that year. So if the plan interest investments were actually earning 4.5% that year, participants would get 4.5%. Again, this is something that the actuary works with the accountant and the plan sponsor on to make this determination. Next slide, please. The different approaches, the market rate approach helps stabilize the plan's contributions. The fixed rate approach results in kind of really some swings. And this is an issue because if a business owner is expecting to make a contribution of, let's say, 100 grand, and there's been a big swing in interest rates, if they're using fixed rate, that business owner could be in for a big surprise. And let's go to the next slide. So Ricky, why don't you talk about the surprise?
Sure. Thanks, Andy. So if you'll see here, let's first, let's take a look at kind of the last two columns. That's what I want to focus on here. In this example, the business owner had said, hey, ideally, I'd like to kind of contribute $100,000 per year. That's the appetite I have for contributions here. And as under the two designs, you think like, oh, it shouldn't be that big of a difference, even if the market fluctuates a little bit. But if you look there in that column on the second to right, look at those fluctuating contributions. If you use a fixed rate design, you see those actual returns there in the middle of the page, and this kind of resemble, pretty normal. Or at least maybe a little wildly normal stretch of years with returns. We could look at the last 6 or 7 years, and it probably wouldn't be all that dissimilar. And then due to that, you see those. You're promising 4% every year. Well, if you're promising 4%, but your assets earn 12, earn 14, 15%, you know, to keep the assets in line with the balances, you won't have to contribute quite as much because those current balances will earn more earnings than they're promised. So the deductibility, the deductible contribution will be lower. Conversely, which is probably even worse, look at year 7 out there. You got a negative 15% return. Let's imagine that's 2022. You've got some pretty big balances built up over the last 7 years. And then the plan the account just takes a huge hit, 15% loss. Look at that contribution that's required there in the column second to the right. So you go back to that business owner and you're kind of like, hey, I know you only wanted to contribute $100,000, but you actually have to contribute $225,000 this year. That can be a tough conversation, a tough pill to swallow. But if you look at that far right column, if you use a market rate of return cash balance plan, you're really just contributing the cash balance credits that the business owner has elected or wants to contribute. This is a very common strategy in larger law firm plans with a lot of partners, and those partners elect a level of benefit, and that is what they contribute every year. You don't like surprises. That 226,000 is bad, and again, the 67,000 is bad. If your business owner is looking for a $100,000 deduction, and you tell them, hey, you only can get a $60,000 deduction this year, that's not something you want to tell them either.
It's all about managing expectations.
Yes, sir.
Next slide, please. Some additional cash balance features. I'll go to the next slide. Oh, another test. Okay, which statement is not true? No employee contributions are permitted. Younger participants receive larger contributions. Owners' contributions vary based on their income. Annual contributions are required. This is an easy peasy one, folks. This should be pretty straightforward. One of those questions is incorrect. One is incorrect. And we've got almost 2/3 of us voting. Okay, let's take a look at our right answer. Item B is incorrect. Younger participants generally receive smaller contributions. Remember, this is a DB plan, longer period of time to fund. Next slide, please. Cash balance assets, we mentioned this before, they're pooled and managed by an investment professional. Self-direction is not available. There's different ways of handling the interest crediting, as Ricky pointed out. Again, these aren't 401ks, no self-direction. Next slide. Older participants receive larger contributions. Actuaries required to determine contributions. There's 5,500 filings requirements, and there's a funding status statement that's usually required also. Again, this is the record-keeping firm that would handle these things. Next slide, please. Okay, which statement best describes a cash balance plan investment strategy? A conservative rate of return is targeted. Younger participants receive a higher rate of return. Each participant determines their appropriate investment. Fixed annuities are the only permitted investment option. Okay, let's see how our numbers come in. We get most of you voting. We will see where we end up. Okay, let's take a look. Very good. A conservative rate of return is targeted. Clearly, with cash balance plans, we don't want to be swinging for the fences because that would goof up the tax planning for the deductions. Okay, IRS compliance testing. Cash balance plans have compliance tests. Often the cash balance plans for testing purposes is combined with 401k. Now again, this is the role of the actuary. We as consultants, we as advisors, we as plan sponsors, again, we're not necessarily, don't have to get into the detail here, but often it makes sense to combine the 401k and cash balance for testing because it increases the tax efficiency of the employer contributions. It increases the tax efficiency. Next slide, please. The combining plans, sometimes this is called cross-testing. Not going to get into this in a lot of detail. If you've got questions on that, we can sure cover it at the end here. Next slide, please. Cash balance plans have a unique test called the 40-50 test. This means at least 40% of the eligible employees must receive a benefit. Now that benefit has to be meaningful, but actually if you look at what meaningful means, it's pretty small. A meaningful benefit is half of 1% of compensation paid as an annuity at retirement age. So the meaningful benefit is actually pretty small. Next slide, please. One rule that's got a lot of misunderstanding and speculation is something called the permanency rule. And the rule is simply this, that an organization establishing a cash balance plan shouldn't do it unless they can stick with it and are planning on sticking with it for at least 3 to 5 years. And while this isn't a specific law, the IRS can challenge a cash balance plan if it's terminated too quickly. So when we're talking with plan sponsors, if they're not comfortable with that level of contribution for at least a 3 to 5 year period, maybe cash balance isn't a good option for them. Now, for example, if the business, say you've got a small business and it was set up and in year 2 the business owner died, yes, in circumstances like that, that isn't generally going to be a problem. But again, assuming there's nothing catastrophic happening, the 3 to 5 years should be considered a minimum. Next slide, please. Some cash balance plans are subject to what's called PBGC coverage. And let's explain what that means. The Pension Benefit Guaranty Corporation, or PBGC, is a federal agency that insures pension benefits if the plan sponsor goes bankrupt. So if we have a business, the business goes under, there's not enough money in the cash balance plan to pay the promised benefits. If, this is a big if the plan is covered by PBGC, they would step in and make benefit payments. The PBGC is funded by premiums, and premiums are paid by the plan sponsors that maintain cash balance plans. And the premium they pay is based on the number of participants in the plan. And then if the plan is underfunded, that organization has to pay an extra premium. This is PBGC coverage. And this is something, again, the actuary will take a look at the organization and make a determination whether they are or are not subject to PBGC coverage. It's not optional. The business either is or is not subject to PBGC premiums. Next slide, please. Well, a defined benefit plan, including cash balance, are exempt from PBGC coverage if there's less than 26 active participants and the business is considered a professional service business, or the plan only covers owners. 26 is the threshold, and the business is considered professional service, or the plan only covers owner. These plans are not covered under the PBGC and don't have to pay premiums. Next slide, please. I should have mentioned professional service. Professional service firms include engineering firms, CPA firms, law firms, etc. Those kinds of entities are considered professional service firms. If you had a manufacturing firm, no, that's not a professional service firm. PBGC coverage potentially could be a good thing, because if your plan is covered under PBGC, then the plan sponsor has a higher deductibility limit. You can put in more and deduct it. So if you've got an organization that is likely to be or is subject to PBGC, that might be a plus. That organization may be able to set aside more and still deduct that based on the needs of the organization. So PBGC coverage, the employer has to pay annual premiums, typically about $100 a participant. If they're underfunded, they've got to pay extra. But if they are covered under PBGC, the plan can, or the plan sponsor can set aside and deduct even larger amounts. Next slide, please. Now, one of the areas where there's a lot of confusion regarding cash balance plans relates to distributions. And the good news here is that the distributions from cash balance plans and the rules are very similar to 401k plans. Very similar. Distributions are available at retirement age and separation from service, just like a 401k. In addition, and this is relatively new, distributions can be made on an in-service basis, assuming the individual is at least 59 and a half. So let's say we had a medical practice and we had 3 docs. 2 of them are 46, one of them just turned 59 and a half. If the plan is written to allow in-service distributions, the doctor who's 59 and a half can take an in-service disbursement from the cash balance plan and can roll these amounts over to an IRA or even to a 401k. Now, like the 401k rules, if the check is payable to the doctor, if the dollars go directly to the participant, keep in mind, don't forget, there is a mandatory 20% federal income tax withholding requirement. We saw one of these last year right around Christmas, where it actually was a physician made a mistake and took a direct payment from their cash balance plan. Their balance was about $1 million. They ended up getting about $800,000. And they called, "Where's my $200,000? Where did it go?" Well, it went into the Federal Reserve System as income tax withholding. So make sure that if you've got a client taking a disbursement, that they're requesting a direct rollover and not a direct payment, because if it's a direct payment, mandatory 20%. Next slide, please.
Hey, Andy.
Cash balance.
One thing.
Yes, sir.
Andy, sorry. One thing I'd like to add there. just just to say that, you know, those in-service distributions can be very nice because, you know, if you're in a cash balance plan with other participants and the assets are invested generally, maybe a little more conservatively than an owner would like, you know, typically, those, as soon as they, you know, take that in-service distribution, of course, then they can invest that money any way they see fit. It does not have to stay within the bounds of the pooled assets in the plan. So that's a huge advantage for owners as well.
Yeah, and that's a good point, Ricky. And I'd like to discuss that maybe in just a little more detail too. One of the objections that I hear with cash balance plans, let's say you've got a partner or an owner, and they've got a million, million and a half, 2 million in that plan. Sometimes they get nervous, they get upset, they get concerned because of the conservative nature of the underlying investments. And typically 2, 3, 4% are, average rates of return. So it does behoove an organization setting up a cash balance plan to allow for these in-service amounts so that partner, that participant with a million, million and a half, 2 million can get that money out at, let's say, 59 and a half and invest that in typically a more aggressive investment style. So that's a common objection to cash balance plans, and I do think that it can be addressed via this in-service option at 59, 59 and a half. Next slide, please. Okay, so let's just quickly review before we get into feasibility. Recall at the beginning of the presentation, we talked about the concept of the number. And the number is talking with the business owners, the partners, saying, ideally, what's your number? Ideally, how much additional would you like to put in? Once you've got that number, once that's been pinned down, really the next step is bringing in the actuary, bringing in the Rickies of the world, and focusing on feasibility. Can we hit that number? Does that make sense? So once we've got the number, now we move into feasibility. Next slide, please. Okay, well, another quiz came up. Let's take a look. Which plan or plans is or are not required to pay PBGC premiums? Not required. Is an owner only required to pay premiums? Is a defined benefit plan maintained by small professional organization? Is a safe harbor 401k required to pay premiums? Or item D, all of the above? In other words, are none of the above required to pay PBGC premiums? And I see most of us have voted. The correct answer is D. Owner only, no premiums. Small DBs, no premiums. 401ks, no premiums. Okay, back to feasibility. Next slide, please. Ricky, you want to cover this?
Sure. So again, we kind of touched on this, you know, Andy touched on this a little earlier. You know, where do these plans fit? You know, where's a good spot to implement a cash balance plan? And again, you know, it's generally, you know, an owner or a group of owners, a group of partners that really have a big appetite for more tax deferral opportunities. And then, you know, as he said, hey, are they gonna, you know, are they willing to do this for at least 5 years? You know, he said 3 to 5 years earlier, and that's a good kind of rule of thumb. Obviously, the longer the better. You know, we don't typically see the IRS or the DOL come after, you know, too many people for getting rid of plans earlier, but you know, you always want to be safe, and you don't want to, you know, become disqualified. There's penalties for that. Nothing you need to worry about. Just make sure that they kind of want to keep this plan, you know, going for a solid number of years, and then, you know, are they willing to contribute a little bit of money toward staff retirement benefits? You know, if they're willing to contribute at least 5%, that kind of opens up the amount that they can then contribute themselves by quite a bit. You know, I talked about some non-discrimination testing that's required in these instances, and that contributing 5% of pay towards payroll goes a long way to not limiting the contributions for owners and partners. And then again, you know, we typically look at people who are a little closer to retirement. You know, there's obviously, you know, business owners in their 30s and 40s that this could make sense for, but typically we're looking at owners in their 50s and 60s. But, you know, again, if somebody's interested in younger, that's not to say you can't do it. It's just, you know, there's more things to consider.
Okay, next slide, please. We've alluded to this, just mentioned there's certain industries where cash balance are more prevalent: medical firms, law firms, capital investment firms, engineering, accounting, actuarial, and also IT and you know, data management firms are good candidates. Next slide, please. The plan establishment process. What do we do to set one of these up? Well, let's go through the steps. Next slide. They're a great tool for the right employer. We've got to make sure it's sustainable. Issues could be poor tax efficiency, could be cost, could be an issue, inconsistent earnings, demographics. But once all these have been considered, if everything seems to fit, then we proceed. Next slide, please. The roles. The actuary does the heavy lifting here. They do the funding status, they do the testing. The financial advisor works with the owner to determine the investment strategy. The third-party administrator, TPA, handles the 401k side and coordinates, in some cases, coordinates the testing. The role of the CPA is to help with determining the tax advantages and cash flowing the contributions. The business owner makes the final decisions. But a lot of the heavy lifting we've talked about today is the role of the actuary. Next slide, please. Finding the right TPA, check around, ask questions, talk to your wholesalers, make sure the TPA's got a number of cash balance plans on in-house actuarial, how many actuaries, etc. Just ask questions. Go with the entity that you feel comfortable with. Probably my best advice. Next slide there. Again, the actuarial side, some actuaries do this full-time, some part-time. Again, working with wholesalers, working with trade associations. Oftentimes we see a lot of actuaries that are just one-person businesses, and that's fine. But, you know, what's their succession plan? What's their backup strategy if something happens to them? Next slide, please. Feasibility study. We mentioned this a few times. The data, compensation structure, objectives, other retirement plans, and the actuary will provide this. Next slide, please. It's a good time to get started. Interestingly, these plans can be set up through third quarter for the prior year. We're probably past that date now for 23, but you can set them up through at least the first 2 quarters of the following year. Next slide, please. Documents are prepared: investment strategy, plan communications, contributions, ongoing administration. Pretty straightforward. Next slide, please. They're a great option for business owners. They can offer increased deductions and accumulation. It's not a one-size-fits-all. Assemble a team and see if it makes sense. What we'll do now is turn it back to our hosts, and we'll take some questions.
Thank you very much, Andy. Also to you, Ricky, for your time and expertise on the matter today. At this point, everybody, we're going to proceed with a bit of Q&A for those that have submitted their questions. We'll get to those in short order here. For those that happen to have questions that they want to ensure get addressed either during this portion or If we run out of time as part of follow-ups that'll go out, please feel free to utilize the questions tab to get those questions in. The first one I want to address for everybody that is inquiring about whether the slides themselves will be available, a link to the recording, etc. Answer to all of the above is yes. Roughly 24 hours from today's broadcast, you should be receiving a follow-up email that contains all of those items as well as some additional materials and information. So keep an eye out for that. I also want to address for those that are interested in receiving and have applied to receive your CE certificates and have qualified for them. Please keep an eye out in your inbox specifically from certificates at simplecert.net. Usually within about 5 or 7 business days, RLC is able to process those certificates and get them out to you. If you requested a designation that RLC cannot accommodate, by default, they'll just supply you with a certificate of attendance for the purposes of self-reporting, and then you'll be able to utilize that in whatever way is best for you. So with that, let's get to the first question. And Andy, I know you said you had a bit of a hard out, so I know you've only got a couple of minutes here. Ricky, I'll inquire, do you have a bit of time or are you in the same boat? Just so
No, I'm happy to stick around if there's additional questions.
Okay, fantastic. Well, the first one I'll offer up, I'll just pose these open forum style for either of you, I suppose. But first question I have here for you is a cash balance plan different than a profit sharing plan? And if so, can you address the aspects in which that allow it to, or that it makes it different?
Sure. The difference is a profit sharing plan is a defined contribution plan, and it's subject to much lower contribution limits. With a defined contribution plan, your benefit is the amount available at retirement. With a cash balance plan, it is a defined benefit plan, and that means that contributions are required and they're not optional. So if a business owner is concerned about being locked into required contributions, clearly a cash balance plan is not would not be suitable for that individual organization.
Okay, next question. Can the contribution amount be changed from year to year, or is it set at the plan initiation and kept at that amount throughout the life of the plan?
Oh, interesting question. Can the contribution amount, the required contribution amount, be changed year by year? And Ricky, I think you're ideally suited to answer that question.
Yeah, so the benefit level can change. You can amend the plan to change the benefit level. But however, on that, any benefits that have been earned cannot be changed. So it can only be amended prospectively. And there are some sort of caveats to that I don't want to get into here. But generally, yes, the plan can be amended. So for example, if an owner, set up the plan and was like, hey, I'm going to contribute $100,000 per year, and then in 3 years, let's say the business isn't doing quite as hot or is doing significantly better, you could change that to 50,000 or to 200,000. There are ways to do that. But again, anything that has been earned cannot be changed. So nothing retroactively, and it is a little more difficult to change things for staff, only because usually at the design phase, the staff benefit levels are designed and set in such a way to ensure that the plan does not fail non-discrimination testing.
Great. Next question. Do you work with cash balance plans for 30 employees?
Andy, I'll take that one as well.
Yeah, go ahead with that. Yeah.
I work
I'm
on,
gonna hop off too.
Oh, okay, great. Thanks, Andy.
Thank you very much, Andy.
I work on cash balance plans from sole proprietors up to hundreds and thousands of employees. So any level in between, I've worked on, basically. And cash balance plans work for all different sizes, of course, depending on the setup of the organization.
Okay, great. Next question. Can you address restrictions on in-service distributions to owners while non-owners are still in the plan?
Yes. So generally the plan needs to be well-funded in order for that to happen. So if a person is a 5% owner or more, that's when kind of restrictions come in, or a top 25 if there are, a significant number of people. Cash balance plans typically are funded very well. So as long as they're 110% funded, after that distribution, before and after the distribution, they can make that. But generally, like owner-only plans obviously are not concerned with this, but if you do have some staff, you would want to make sure that the plan is well funded, which again, in a market rate of return, especially cash balance plan, is usually not an issue to keep it that well funded based on contribution timing and that sort of thing. I see most of my plans are in the 120-ish% funded range, which would allow for owner distributions. If the plan is not well funded, then yes, there are restrictions that would apply. There's some ways around that get a little complicated. But generally, if the plan is not well funded, those would be restricted and not allowed.
Okay, great. I'm just going to toggle in between. We have a slide here that we just want to call out from the TRA side. Now through December 31st, we have a sales sprint going on, waiving of all setup and conversion fees for defined contribution plan sales. So when you guys receive this follow-up email, you'll be able to interact with the click here button to bring you to our landing page to learn more. And next question here for you, Ricky, is if the doctor takes an in-service distribution from the plan that will allow additional contributions. It takes distributions from the plan. Will that allow additional contributions, i.e. the benefit at retirement is reduced within the fully funded plan?
Sorry, can you repeat that one more time?
Sure. If the doctor takes an in-service distribution from the plan, will that allow additional contributions, i.e. the benefit at retirement is reduced within the fully funded plan?
Okay, so the question is if a doctor takes an in-service distribution, will that allow for additional deductible contributions? Typically, no. The reason why is that the assets just kind of need to line up with the liabilities. So when in a cash balance plan, generally those do stay, especially market rate of return, they stay pretty much 1-to-1. And so when the liability comes out, or when the asset comes out for the distribution, that also removes liability from the plan. So it doesn't really increase it. There is sort of a little trick, which I don't think the person asking the question is getting at, but there are lifetime limits for individuals in these plans. And the earnings on these benefits do count towards those lifetime limits. So if you take the in-service distribution like annually, for example, you kind of remove any of those earnings really from the plan. The earnings will come outside the plan in the 401k or the IRA or whatever they choose to roll it over. And then that can allow for, slightly higher contributions, but generally no. The assets and liabilities are kind of 1-to-1. And when you take the assets out, the liabilities also come out of the plan.
Great. Actually, speaking of that market rate of return, can you talk a little bit more about that? Can existing plans get updated? Are there drawbacks or for a new plan going this route?
Absolutely. So yes, the question is, can an existing fixed rate cash balance plan be converted or amended to become a market rate of return cash balance plan? And the answer to that is most certainly yes. We do that quite often, especially for smaller plans, kind of smaller owner only type of plans and partnerships. But drawbacks for market rate of return. One drawback, it's no different than a fixed rate of return, but there is what is called a preservation of capital, which means that if somebody's promised $1,000 a year for 5 years and the market goes down, 10% each year, that person is still owed $5,000. Even though, it's quote unquote market rate of return, there is a floor of 0%. A participant cannot lose the promised benefit. So, but again, in a fixed rate of return plan, also the same drawback there is you're promising them 4%, not 0. So it's even worse if in the years with negative rates of return. Otherwise, no. Secure 2.0, especially Secure and Secure 2.0, especially have really confirmed the use and acceptance of market rate of return cash balance plans. They've there's no drawbacks that would be any different than a regular fixed rate cash balance plan, which would just, be kind of the required contributions, that sort of thing.
Okay, great. Yeah, similar question here about rates of return, but I just want to ensure that it's asked. So
Mhm.
when using an actual rate of return, is it still tied into a future value that is targeted, i.e., if the plan earned 10% every year and the AIR is 6, does that change funding?
No. Just to repeat that question, if the plan earns 10 in the assumed rate of return was 6, no, because the benefit, you're still funding the level of benefits. So again, if the level of benefit is $100,000 and the participant earns 10%, let's just say, and it goes to $110,000, and then it's $100,000 the next year, the contribution level is still $100,000. They're Now, plans can put in a maximum rate of return, which that's what Secure 2.0 kind of, we've kind of, they've confirmed that that's not required. So I had plans with like a 6%, cap on benefits. And in that case, yes. But we have since, we are working to remove the caps on all of these plans, and caps are not required. So now, no. An incredibly high rate of return does not lower deductible contributions in future years.
Okay, great. Next question. What is the typical eligibility of who is considered for an employer's cash balance plan?
Okay, so eligibility for cash balance plans is the question. And honestly, it's all over the map. I work on some plans that are partner only. I work on some plans that do include staff. It really just depends on the design and the appetite and the business's, goals, everything. There's no requirements. I've seen the run the gamut of participation, and yeah, they can kind of do what they want within reason, depending on the design they're looking for.
Okay, next question. Is the only condition for in-service distribution age?
Yes, the only condition for in-service distributions is being above age 59 and a half, except like the prior question, if a plan is not well funded and the person is an owner, there can be restrictions. Actually, any highly compensated employee or owner, depending on the size of the plan. But yes, there can be, but again, most of these plans are well funded. That's by design, so this is not an issue. But generally, yes, the only condition is being above age 59 and a half.
Okay, next question. Can cash balance assets be Rothified?
The question is, can cash balance assets be Rothified? And the answer is yes. Well, depending, post distribution, yes. So you can, move that into a Roth when you roll it over, when you take a distribution from the plan and roll it out. The assets in the trust, it's a pooled account, and those are all obviously pre-tax because the whole point of them is to get the tax deduction.
Okay, and can you discuss the number of years a plan needs to be there before any in-service distribution comes into play?
The number of years before an in-service distribution comes into play? Is that the question?
Yes, that was the
Uh,
question.
uh, One. I mean, if the first year of the plan, somebody can put money in. If they're age 60, they can take it out that first year.
Okay,
After the first year,
next
once
question.
the contribution's made. Sorry. So once the credit is, first year is a little tricky because usually the credits go in at the end of the year. That's pretty typical. So if a plan was established, January 1st, 2024, the credit would kind of be credited 12/31/2024. And then once that contribution is made, which is typically either right at the end of the year or early in 2025, once the assets are in the plan, then a distribution can be taken. There's no requirement for number of years that the plan had to be active.
Okay, next question. What are the typical investments that you would use in a cash balance plan?
Sure, that's a good question. Investments are always a hot topic when designing the plan. Again, I will just answer this kind of vaguely and just say that I've seen a wide range. I have one plan currently that is just in a money market. Given the return there, they're happy with 4 or 5% right now. So they have 100% of their assets in that. Most are in most that I see, depending on size. Smaller plans, kind of sole props, partnerships, those like small partnerships, those sorts of things. I've seen, I don't recommend this, but real estate, it's hard because you have to get that valued every year. Mostly it's index funds, mutual funds, ETFs, that sort of thing. Just kind of just, it's generally like Andy had kind of said earlier, generally in the cash balance plan, since it is a pooled account, and it's kind of assets for everybody, it's typically a more conservative approach, hence the index funds. But usually, like I said, I've seen, you get sole proprietors who invest in real estate, insurance contracts, a lot of things like that. That gets a little messier and a little hairier when it comes time to terminate, because you've got to get out of that, to got to get that money out, and it's not always so liquid. So I try to push for more liquid vehicles. But yeah, generally, I've seen everything. It's sort of up to the business owner, and advisor and CPA, whoever is helping them on what they want to do.
Okay, next question. Can you discuss what happens when a plan is overfunded?
Yes. So depends when we're talking. Let's say a plan, for sake of this question, if the person who asked this wants to follow up, please feel free. I'm going to say at termination, because if it is overfunded prior to termination, I guess I can talk about that too. You can always increase benefits to kind of bump up to the assets that you have in the plan. At termination, those can be used to pay termination fees. You can always bump up benefits right at termination. You're always allowed to do that. Giving more money to employees is never disallowed. If for some reason there is no room to do that, no appetite to do that, there is an excise tax that is payable on excess assets at the time of termination if they are not rolled over into another retirement plan. A lot of my plans do, if they start getting overfunded, you can do kind of like a termination restart, where you terminate that plan, kind of create another plan, maybe with bigger benefits, and you can roll over the excess assets into that plan to start there. But yeah, generally, for example, if there is no staff and it's owner only and there's excess assets, there will be, an excise tax on those assets at distribution. But we try to avoid that. And that's why market rate of return cash balance plans are great, because you kind of avoid that, because you never really develop an excess as much as you do in a fixed rate plan. If you're, let's say it's 4% in the last 3 or 4 years of the plan, the markets are great and you're earning 8 to 10%, and you end up overfunded. But in a market rate of return, your benefit will also earn that 8 to 10%. So the plan is less likely to end up in an overfunded position.
Great. Next question. I think this is a good one. Must the 401k and the cash balance plan have the same record keeper?
No. That is a very easy question. No. That's it. Just no.
Perfect. Can a sole proprietor have a cash balance plan?
Absolutely. I've worked with real estate agents, kind of like medical sales reps, all types of sole proprietors, kind of just regular consultants that I've worked with. Yeah, the answer to that is yes.
Okay, and the last one I think I have here for you is if the business owner passes away, what happens to the cash balance plan?
That is a good question. It sort of depends on the organization. So it's maybe follow up with that one, and I can, if the person who asked that, it's sort of a more complicated answer, just because it really depends on the plan. Again, if it's like a sole proprietor, obviously, just things get paid to the estate. If there's multiple partners, the the one partner would just be paid out and he'd get his benefit paid to an estate. If it's a sole owner with a staff plan, that would depend on what happens to the business, because the plan is not attached just to the owner. It would be attached to the organization. Does that make sense?
Yes.
So it would depend on what happens to the organization. Yeah.
Great. Yeah, Ricky, thank you so much for sticking around and answering questions. We really, really appreciate it, as well as your expertise today. I'm going to go ahead and toss it back to our MC, Craig Harm, to close us out for today. Thanks a lot, everybody.
Fantastic, Ricky. Thank you. It was a great tag team with you and Andy and Travis. Great job moderating your side as well. Sales Sprint, go for the gold. And the bottom line with the cash balance plans, let us do a proposal, number one. Two, let us be your co-pilot on this. You know, we've got our regional consultants, our regional plan consultants out there, and Travis is going to include the map, our latest distribution team map out. But hey, this is what we do. Let us be a consultant. Let us do proposals for the cash balance. And I thought it was excellent. And based upon the feedback, I'm sure Bill Sunigal, our head of marketing, and Travis will sit down and think, hey, in early 2025, do we have round 2 of a cash balance webinar with Andy? And, you know, from that standpoint, I think the answer is very much so. I think there's going to be a big interest in having the team back together. And I can't thank everybody enough for joining us. It was a quick summer, and now we're into the fall and the sales sprint. So thank you, everybody. Have a great rest of the day, and we'll talk to you later. Take care.